Good afternoon. This is Joan Young. Welcome to our webinar on succession planning. This webinar is part of our exit strategy series that Sunbelt Business Brokers offers to our clients, and it's really here to inform business owners so that when the time is right for you to move on to the next venture or retirement, that you're really well positioned to maximize what you walk away with at closing. So as you might already know, timing is probably one of the most important things in making sure that your business is in the best possible shape so that when you are ready to exit, that's key. I'm Joan Young, the president of Sunbelt Business Brokers, and just as a quick commercial, Sunbelt is the largest business brokerage firm with over 240 offices worldwide. Our office is based in San Jose, and we've been helping sellers throughout the Bay Area for 15 years and beyond to really achieve their dreams in moving on to either retirement or other interests. I'd like today to introduce you to Steve Popel of Exit Track. Welcome, Steve.
Thank you.
Steve has designed the Exit Track process to assist owners to increase the strategic value of your company, to support a much more lucrative sale within 18 months to 5 years from now. And hopefully you saw in the webinar invite that Steve's been a general management consultant for privately held companies since 1970. He's also authored the popular book Big Profits from Small Companies, which has been published in the U.S., United Kingdom, and Spain. So, Steve, I'm impressed.
Thank you.
So we're more than glad to answer some of your questions at the very end of the webinar. So if you'd like to enter your question as we go along in that chat box at that bottom left-hand corner, please do so, and then we'll cover just as many as we have allotted time. It is a 45-minute webinar, so if by chance we don't get to your question, feel free to contact Steve or myself, and we will put that information as the very last slide. So why don't we get started? We have just about everybody here. We'll probably have a few stragglers. But Steve, if you could answer for the attendees today, really what is the difference between a financial sale and a strategic sale, and why does it really matter?
It's very important, and the difference is really all bound up in the buyer's return on investment. Return on investment is something that all business owners deal with every day, and the buyer's return on investment is really the critical issue. In a financial acquisition, if you want to have the next slide, please.
Mm-hmm.
In a financial acquisition, the buyer's return on investment comes exclusively, and that's the key word here, exclusively from sellers' independent earnings and cash flow. Big company A buys small company B, sets it up as a wholly owned subsidiary, and it keeps on doing what it's been doing. That's not where the real money is. In a strategic acquisition, the buyer's return on investment is all of that plus the additional earnings and cash flow that both buyer and seller generate because they are together. It's what people used to call synergy. Doesn't matter what the term is. The main issue is that buyer, which is so much bigger, can increase its return on investment primarily from its own increases in earnings as a result of having acquired the seller. Critical distinction.
Okay.
Just give you a little mathematical example to clarify it. Let's assume that the buyer is 10 times bigger than the seller. And as a result of making this acquisition, the buyer increases its earnings by just 10%, not a lot. Well, what that represents, next slide please, is precisely the same dollars as if the seller had doubled its earnings. How does that work? Next slide will show you just how it comes out. Let's say, for example, the buyer's pre-acquisition earnings are $10 million, sellers are 1, buyer 10 times bigger than seller, as we talked about before. Buyers increases its earnings by 10%. Well, 10% of $10 million is $1 million. Well, if seller increased its earnings by $1 million, that will be a 100% increase. Huge difference. And that's only at 10%. If the buyer increases its earnings by 20% or 30%, that's just like the seller tripling or quadrupling its earnings.
Wow.
That's one of the reasons why in a strategic acquisition, the typical 6 times or whatever the multiple is on EBITDA, standard thumb rule in an industry, doesn't really come into the conversation, or certainly should not. So that, in summary, going back to that slide where you just were, in a financial acquisition, the price is based exclusively on the seller's earnings. Going forward, one more. There you go. In a financial acquisition, the price is based exclusively on seller's projected future performance. Next slide. Whereas in a strategic acquisition, the price is based primarily on the projected increase in buyer's future performance. Huge difference. So where does this all come out? Bottom line, in the negotiation for a financial acquisition, advantage buyer. And a typical example of that would be what's called a roll-up. That's a term that's probably familiar to many of you on this webinar. That's where one company buys a number of companies within an industry on a financial basis, puts them all together, and then takes it public or sells it as a strategic sale. Great for the buyer, not so hot for the seller. However, in a strategic acquisition, the negotiating advantage is to seller. Makes all the difference in the world.
So are you saying that if a company is a valuable strategic acquisition target, that can make the usual industry multiples of EBITDA irrelevant?
That's exactly what I'm saying. There'll be some kind of a multiple, but the multiple will typically be much higher. And that's particularly true if the process that leads to the ultimate sale is one that results in what we call a strategic auction. In other words, multiple strategic bidders trying to acquire the seller. That's the ideal situation.
Okay. Are you seeing more of that coming back with the recession behind us?
Putting the recession behind us, it has a couple of effects, actually. That's a very interesting question. One is that there has been a lot of money sitting on the sidelines because people were concerned about risk, and now that money is kind of licking its chops trying to get into the game. So that's a major thing. Another aspect of it is that there is a lot of pent-up sales demand, so to speak. In other words, a lot of sellers who had planned to sell in 2008, 2009, 2010, maybe last year, have found that the prices simply weren't there and have postponed it. So there's a lot of sellers who are going to be coming into the market all at once who weren't there before. This whole situation is exacerbated by the number of baby boomers who will be coming online to sell. And we estimate that over the next 10 years, it'll be well over 1 million baby boomer companies that will be coming for sale. What that means is that unless a seller finds a way to distinguish itself from others in its industry that are competing for the same buyers, it is very likely to be lost in the white noise.
Right. I've read the same things. Okay. So some examples?
Well, a classic question that we get when we talk to prospective sellers is, well, what is a strategic asset? How does that all work? And the interesting thing is that you can identify various strategic assets, such as, for example, complementary product offerings, complementary service offerings. It's very clear that if a buyer and a seller are selling into the same industry and they have different product lines or different suites of services, after the acquisition, they can engage in what's called cross-selling, which means seller can sell buyer's products and buyer can sell seller's products. That makes each of them, it gives each of them a wider product line or a wider suite of services. Mm-hmm. The interesting thing is, and there'll be others that we'll just talk about briefly as we go through this section, different strategic assets will be valuable to different buyers and some not so much. For example, let's say that there is an East Coast company that wants to have a West Coast footprint. Well, if you have a strong a geographical footprint in this area, that's a valuable strategic asset, or that's a strategic asset, I should say, that is valuable to that particular buyer. If the buyer already has a national footprint, not so much. So what you try to do is to find out which strategic assets are most valuable to the folks who are going to be buying you.
Okay.
Next slide, please.
Okay.
One thing that is obvious to everybody is that if you have industry-leading technology, that is a strategic advantage. However, if that technology is thinly based, that is to say you have a very small technology infrastructure, that reduces the value of that particular strategic asset.
Okay. What about if the company has industry-leading technology, but it's largely, kept in the head of the key person there, the technologist? Is this going to be a problem for selling the company?
Well, it may not be a problem for selling the company, but it will definitely have a negative impact on the price. I mean, put yourself in the position of the buyer. If the principal reason, or one of the most important reasons why the buyer is buying the seller in the first place is the seller's technology, and the situation is as you've described, Joan, that it's all in the head of one individual. Well, what if an individual is injured or leaves the company or what have you? All of a sudden, all that technology might as well just have walked out the door. So buyers are very alert for this sort of thing, and they want to make sure that if technology is the main issue, that there is a genuine technology infrastructure which is protected from the departure of any one key individual.
And you can be held hostage by that key one employee, too, if they know that they have all the goods.
Absolutely. It doesn't have to be adversarial, even if an individual realizes that that's the situation. A lot of times, folks who are in technology want to spread it around. They like being a teacher. They like being a mentor. They like bringing up young people. They like seeing people progress. And if you have that kind of an individual, the situation does not have to be adversarial where an individual says, well, I really want to keep this all to myself. It can be much more attractive because there's so much there besides simply the technology that's in this individual's head.
True. Okay.
One of the things that has surprised me over the past few years has been the importance of key customers. Even if buyers are large companies themselves. You would think if you're a company that has sales in the billions, you're going to have all the key customers that you want. Well, not so much. If the seller has an Intel or a Raytheon or whoever it happens to be, AMD, whatever, and they can help the buyer to get an introduction to the proper people at that seller, that can be worth huge amounts of money. And so any seller of any size that has a very strong relationship with customers that are both large and have a high profile, that's a very valuable strategic asset, and they really are going to be very appealing over and above whatever else they have to offer.
Okay.
We've already talked about geographical strength and how that works into it. One marketing channel that can be important is, for example, a line of distributors. What that allows buyer to do potentially is to present its products to entire new customer groups or possibly entire new geographical regions. That can be extremely important and very valuable and worth money to the buyer.
Yeah, I've seen that work beautifully. Yeah.
Strategic ventures, strategic alliances or joint ventures, that can be important for the same kinds of reasons as the distributor network. It's relationships that the seller has that can be passed on to the buyer and that the buyer can take advantage of. And because the buyer is so much bigger, a lot of times they're able to take even better advantage of it than the seller has been able to do.
Mm-hmm. Okay.
A lot of people, sorry, go ahead.
I was just going to say, what is what is an acquisition hub?
Yeah, this is a term that's not familiar to most folks. Acquisition hub simply means that the acquired company becomes the vehicle for making additional acquisitions in that region, in that industry, or both. Mm-hmm. And this is particularly valuable if the owner of the seller is highly respected in the industry. For example, president of the a professional or trade association. That can be very valuable. If buyer buys seller in California, let's say, and the seller has been the president of the California Association of whatever it happens to be, mm-hmm. well respected, well known, that individual calls up somebody and says, you know, Fred, our company was bought by such and such, as you may recall. It happened about 6 months ago, and I can tell you, they are great to work with. They paid a fair price for our company. They didn't come in and knock out all our people. They protected our people. They provide career opportunities. They've just been wonderful to work with, and they've helped us to make more money, and we've helped them to make more money. It's just a great relationship. You might want to consider selling these guys. They're really, well, that kind of recommendation from a cohort can make the difference between a chilly reception from the seller to a buyer's initiative to buy their company, and one that's quite warm or at least thoroughly open. Very important.
Okay, good.
When we talked about technology before, we mentioned how important it is for the buyer to make sure that the technology is not wrapped up in one person. Well, this is even more true as you go across the board, and particularly in general management and the key departmental functions. If a company is run by the owner and what I call a cast of Lilliputians, that can have a significant downward impact on the value of that company from the buyer's perspective. Why? Well, put yourself in their shoes. The company is successful, making a lot of money, good financial condition, good position in the marketplace, all the things that you're looking for, plus strategic assets that are valuable, except that all of the management decisions are made by one person. Well, what happens if after the acquisition, that individual is injured, dies, leaves the company, or simply becomes less motivated because his or her eggs are no longer all in that one basket? Well, that is a severe problem for the buyer, and if they see that that's what the situation is, they are not going to be willing to pay as much for that company. So a broad and deep management team going down to the department level and within the department level. Very, very important.
And I've even seen, companies that think they're ready to be acquired or to sell. Once we really start talking about this really does put off the timing of that for a year or two till they can build their management team to be stronger and that it not all be about Bob, as I say.
Well, that's absolutely right, and I think if a company does not have a compelling reason to sell, that the owner is ill or a spouse is ill or the company is in serious financial trouble or whatever it happens to be, if there is no compelling reason to sell, in the vast majority of cases, ownership will be much better advised to develop a plan, say a 3-year plan, to build value into their company, both financial value and strategic value, and address issues early on of what are called due diligence questions. And if you have questions about that, let us know. We can talk about that in detail in the Q&A portion at the end. Main thing is, don't rush. Get yourself a plan and work against plan so that by the time you're ready to sell, you are precisely what a lot of buyers are going to be looking for.
Okay.
Now,
yeah, I thought you could maybe give us an example or tell us a little bit more about the exit track process. What's unique about it?
the unique aspect of the exit track process is that we interview in real time key acquisition executives in prospective buying companies. Well, why do we do that? Well, let me just give you an example from ordinary daily business operations. Pretend for the moment that you are the owner of an office furniture manufacturing company, and you have a new product line that's well beyond the concept stage, but not nearly far enough along to bring to market. To whom would you talk in order to get a solid idea as to whether this new product line will sell, at what price, bells and whistles, terms, delivery, etc.? You would talk to customers and prospective customers. It's what company owners and managers have been doing for generations. What we have done, next slide please, is to simply take this time-tested concept, this time-tested idea, and apply it to the sale of a whole company.
Okay.
So what we do is, in these interviews, learn which strategic assets prospective buyers find most valuable. Very simple concept. Then we build the company's strategic profile to match these marketplace values. So we find out what the customer, now in this case is the buyer, we find out what the customer wants, and then we become that.
Mm-hmm.
Next slide, please.
Mm-hmm.
So what we do first is to design a questionnaire that is customized for the client and the industry. And the purpose of these interviews and the purpose of designing these questionnaires is three things. First of all, get the interviewees' perspectives on the history of the industry. Second, the future of the industry. And finally, and most importantly, which strategic assets would be most valuable to them if their company is to acquire a company in the client's industry today, and how those preferences are likely to change, if at all, over the next few years. And there's one other thing I want to emphasize in terms of questionnaire design, which is often missed, and that is what we call the Hippocratic Oath of exit track questionnaire design, and that is first, do no harm, which means under no circumstances allow anything in the language of the questionnaire, the run-up to the questions, the conversation with the interviewees, nothing that gives anyone the opportunity to identify who the seller is. That's absolutely critical, and we make certain that that's the case in all of these questionnaires. So then once we have the questionnaire, we interview 15 to 25 of these key acquisition executives. Next slide, please. Mm-hmm. So we do 15 to 25 interviews. They're all on the phone. And oftentimes people say, well, how in the world do you get people to talk to you? Why would they? Well, we use a very original concept. We tell them the truth. What we do is we say, we have a client, and then we describe generally what the client does. Not enough to be able to identify it, but enough for the interviewee or prospective interviewee to get a sense as to whether they're interested in this type of client. And we say this client wants to become a valuable strategic acquisition candidate, which is why I'm calling you. And if you are kind enough to give me 10 or 15 minutes of your time on the phone to answer 7, 8, 9 questions, never double digit, then you have my word that when my client is ready to begin the sale process, you will be among the first to know. Why wouldn't they talk to us?
Right.
We're advising a client on how to become precisely what it is that they want to acquire. So the previous slide, please.
Previous.
So yes, that one. Thank you. The outgrowth, the sum total of these 15 to 25 interviews with key acquisition executives in prospective buying companies, once you have collated and analyzed the results of these interviews, what you have is the profile of the valuable strategic acquisition candidate in this industry. Very simple, very straightforward. Then, obviously, the next step is to compare that profile with the actual strategic profile of the client company, and management makes decisions as to which strategic assets to build or buy in order to get their profile to be as close as possible to what the marketplace has said it finds valuable. Next slide, please. Here are the management decisions. Which strategic assets to build or buy, and that's critical. And finally, once those decisions are made, they are subsumed in an action plan that also includes other elements to buttress the P&L and the balance sheet going forward. So, next slide. The three objectives that you have in this action plan are, first of all, to incorporate management's strategic asset decisions. Second is to develop strategies for optimizing P&L. And third, for optimizing financial condition. And I want to go back for just a minute to the strategic asset decision process, because that's very important. These decisions are typically made based upon the same four things that other strategic decisions are based on: money, people, time, and confluence with values. So it may be that these interviews determine or help us to determine that there are 5 things that this company could do, 5 assets that they could consider or should consider building or buying in order to get their strategic profile as close as possible to what the marketplace has said it finds valuable. But it simply doesn't have all the people to do it. Well, if you don't have the people, that can break down into 2 things. One, you don't have the skill sets. That's possible, in which you maybe can hire the people who do. Or second, your people do have the skill sets, but their plates are full. In which case, maybe you need to offload some of their duties so that they can take this on, or make some other kind of investment. Most of these kinds of decisions have financial ramifications, and all of what it is that anybody does to try to become a valuable strategic acquisition candidate has to be within the confines of their own resources. Also, time. If a company wants to sell in 3 years, but complete building of a valuable strategic asset is going to require 5 years, they may say, well, we're not going to do that, or we're only going to do it partially, such that, for example, going back to what we talked about before about geographical footprint. Let's say that a company has a strong position in Northern California, and a buyer wants to have regional geographical strength, which is to say west of the Rockies, for example. And maybe they can go into Southern California within 3 years. Maybe they can go into Southern California and Oregon and Washington so they can present the buyer with a West Coast presence, but really doesn't have the time or other resources in order to get into places like Arizona, New Mexico, Colorado, Utah, et cetera. So those are the kinds of decisions that would be based upon, again, money, people, time, confluence with values.
Okay.
So finally, what does this action plan, this strategic plan, look like? Next slide, please.
Mm-hmm.
There are 6 elements to the action plan. First is the vision. That's the identity of the company. When someone sees your name or when someone sees the logo of the company, what image do you want to come to mind? What is that identity? Mission is, what do we do and for whom do we do it? Sometimes there's some confusion about vision and mission. And what I've always found makes it easy to get rid of that confusion is to think about it on a personal basis. My vision is my identity. Who am I? My mission is what do I do and for whom do I do it, which in the case of an individual is who is my employer and what's my job at that employer. So again, at the corporate level, vision is the identity of the company, mission is what do we do and for whom do we do it. The vision and mission and also the long-range goals are set at a time in the future, let's say 3 years out, for example. Long-range goals can be financial, they can be market penetration, they can be market niches that you want to enter, whatever is important and seems like it can help to build significant strategic value, value that will be seen as strategically valuable by buyers. Short-term objectives or annual goals, that's what do we need to accomplish in the next 12 months in order to get a leg up on achieving the long-range goals. Task assignments are usually laid out by quarter, and they're assigned to a specific individual with deadlines. And by definition, the achievements of the task assignments, the completion of the task assignments, helps to achieve the short-term goals, which again, in turn, gives us a leg up on achieving the long-range goals. Action items are what I call, what do we do Tuesday? That isn't a goal or an objective or a task. This is something we actually do. I'm going to pick up the phone and call the ad agency. I'm going to do something else. It's a do. It's not a think about. It's not a goal. It's an action. So once you have this entire action plan, one of two things is going to happen. Either it's going to be live or it's going to wind up in the lower right-hand drawer of the desk and never be heard from again. Obviously, the only way that an action plan can have a material impact on the company and in the context that we're talking about today, a material impact on the ultimate selling price of the company and the price, the terms, the way in which the non-economic benefits, such as protecting employees and making sure that they have career opportunities, things of that sort. The only way that that happens is if there is periodic follow-up that compares actual performance with plan. We recommend that that be no less often than quarterly and that there be an annual follow-up session that looks at what has happened in the past year. Are we caught up? Are we not? Are there any mid-course corrections that are necessary? All of those kinds of things. And also, and this is something, Joan, where you could bring in a lot of value to that annual review, and that is what has been happening from an M&A perspective in the preceding year. Who has bought whom and why, and what does that suggest about the growing list of prospective buyers that you would be contacting when the client says, okay, I'm now ready to sell the company. So what you have then finally is this action plan based upon the strategic decisions that management made as to which strategic assets to build or buy to get that profile as close as possible to what the marketplace has said is valuable. And those decisions are pursuant to the data that we gathered from the 15 to 25 interviews with key acquisition executives in prospective buying companies. And what will happen is there will be these annual reviews, there'll be the quarterly follow-up, and eventually the client will say, okay, I'm ready to sell. I think I've got a strategically valuable company. I'm ready to pull a trigger. Joan, let's sit down and get our process going to sell this company.
Yeah, I think it has been, I'm a certified provider for Exatrack in the phase 1 process, and then of course the phase 4 is taking your business to market. But I've just seen how valuable this is if your business isn't ready, just to be able to, assist you in increasing the strategic value so that you can sell it for a much more lucrative price down the road. Thank you so much, Steve. I thought that was very clear and very well done. We do have one question that someone wrote in that said they haven't acquired any other company but have considered it, but would this process help them in finding the best companies to acquire?
Absolutely, because what happens, as we talked about, is that we interview key acquisition executives and prospective buying companies and use those data to determine which strategic assets ownership should consider building or buying in order to get that profile as close as possible to what the marketplace has said is valuable. Well, some build or buy decisions are simple assets. We're going to build more plant, for example. We're going to buy a building, or we're going to hire 2 individuals to buttress our technology, whatever it happens to be. However, other build or buy decisions can be, are we going to open up a new office in a remote geographical area, or are we going to buy a company in that geographical area? And if so, which one? Which kinds of strategic assets, besides, in this example, geography, what other kinds of strategic assets can the seller bring to my company as the buyer that the buyer for my company will in turn find valuable? So this process can very well inform the process of acquiring other companies if that is a part of the company's growth plan.
Okay. Thank you, Steve. Another question was, what revenue does a business have to be generating to attract a buyer? And I can approach that as well. It really depends. Are you a business that's generating under $1 million? You're not going to be attracting private equity groups. They need to have the EBITDA to be at least $1 million, and they prefer 2 to 5. But if it's a larger company, mid-market company, Steve, what have you found as the number that buyers are looking for? Is it over, I don't know, what would you say for revenues?
The buyers, I think you have correctly identified the fact that if a company is less than $1 million in annual sales, we're looking at a different kind of a purchase process. Once a company gets in excess of $1 million in sales, let's say it gets up to $5 million, for example, that would be attractive to a lot of companies. And particularly if the company is well managed and if it has a strong P&L history and a strong financial condition and has some assets that are strategically valuable for that buyer. For Exit Track, we'll go down to maybe 2.5 or 3 million annual sales as a minimum, because companies larger than that are the ones that can really take best advantage of this process. But I think that $3, $4, $5 million in annual sales, certainly $1 million in EBITDA, that's going to get anybody's attention.
And I would say for businesses under $1 million in revenue, most people are looking for sellers' discretionary earnings to be over 200, 250. That starts making your business look much more attractive. And then, you have a wider net that you're able to pull from. But, we get calls from people that their business is maybe making 100, and those businesses just aren't selling very well right now.
Yes, and I think it's also important to make sure that the term profitability is clearly understood by everybody. Let's say, for example, that a company has $750,000 in sales and generates $100,000 in profit or $150,000 in profit, and we think, okay, $150,000, well, that's 20% pre-tax. Well, if it's 20% pre-tax after paying an appropriate salary to the owner, great. Then that company has a lot to recommend it. If, on the other hand, the owner's reasonable salary is $150,000, then that company, for all practical purposes, from the buyer's perspective, is at break even. And it is what one often hears referred to as a lifestyle business. So it's really important that the seller be realistic about what profit is. Profit does not include the owner's salary. Right,
for larger firms. Another question was, does this apply to small businesses, say $1.5 million to $3 million? Can a strategic acquisition apply to a franchise? And I would say yes. If if it is another company doing what you're doing or would like to add you for other the reasons, strategic assets that Steve covered, I would say yes, it could. It's just that the franchisor has to approve the acquiring company. Now, what doesn't happen is a franchise of another name acquire another franchise. But if it's an independent owner, yes, that could happen. But you have to be careful with the laws that the franchises have. And yes, it really, I've had quite a few strategic sales from $1.5 million up. So it doesn't necessarily have to be a $5 million company. It's a company that likes what you have, likes the assets that you're offering, and there's something that can help them grow their company. Yes, it can happen. Would you agree, Steve?
Oh, I absolutely agree. And I want to just, because we only have just 3 or 4 minutes left, I want to just go back to something that Joan alluded to very briefly before, and that is the Sunbelt Bay Area is a certified exit track Phase 1 provider. And we haven't talked very much about Phase 1 because it wasn't part of this program, but it is primarily the fact-gathering aspect of the business is critically important. And I want to say that we don't just certify anybody. Joan and John Young are the only ones in this area that Exit Track is certified, and that's because they are first-rate and their company is first-rate. And so I'm sure all you folks who have gotten on the webinar have already decided that, but I just wanted to add the Exit Track imprimatur on that judgment because we found Joan and John and their firm to be just thoroughly professional, experienced, and splendid to work with.
Thank you, Steve. There was another question that I believe I can answer that they said if you're going to be selling your business in 3 years, when's the best time to connect with the broker? If your business is well situated, your bottom line is strong, and we typically can sell a business within 6 to 12 months. But if there's some of the things that Steve has talked about that you would want to work through the Exit Track process, typically 3 years before you sell it is a perfect time. Would you agree, Steve?
I would absolutely agree with that, and that's the amount of time that you're going to need. In fact, if somebody came to me and said, I want to sell my company within 6 months to a year, I'd say that's great. I'll introduce you to a broker. If it's in this area, I'd introduce you to Joan or John. But you're not an Exit Track client because it simply takes a lot longer than that in order to have a material impact on the quality and breadth and depth of your strategic profile. So absolutely, 3 years, a selling time frame would be perfect, and you would want to contact the broker right away. You want to contact Joan or John right away and say, hey, we want to sell. We don't want to sell right now. Let's sit down and talk about how we build a plan to maximize the value and maximize the selling price of this company.
Right. We have a couple other questions, but I think I will have to do those offline because I want to honor our time of 45 minutes. But I want to thank each of you for joining us today, and hopefully you've been able to pick up some nuggets that will help you in the future. And feel free to go to our webpage, sunbeltbayarea.net, and we have probably a dozen webinars that have to do with exit strategies that I think would help a great deal to you. So feel free to, let me give some contact information here. Feel free to contact Steve directly or myself, depending on what your question is, and we'll be more than glad to work with you. And thank you again, and hope to talk to you in the near future. Bye-bye. Thank you, Steve.
Thank you.
Bye-bye.
Thank you. Please stand by.